Here is something nobody in your school, your family, or your first job ever told you. The tax code is not a burden placed equally on every citizen. It is a menu, and the people who built it, or paid the people who built it, have already ordered. They are eating, and the rest of us are standing outside, looking through the glass, paying full price for a meal we never got to choose. This is not a conspiracy. It is not even a secret. Everything I am going to show you today is legal, documented, and hiding inside the same tax code that is currently taking a percentage of everything you earn before you even touch it. Here is the uncomfortable part. The wealthy do not just minimize taxes, they weaponize the tax code to generate actual cash flow, accumulate assets faster, and pass entire fortunes to the next generation without the government ever collecting a bill. You will pay taxes. They will use taxes. That gap between paying and using is the distance between a paycheck and a portfolio. By the end of this video, you will know exactly how that gap works. Not in theory, not in inspiration poster terms. In mechanics, the actual structures, the actual strategies, and this is the part that will disturb you the most, the small versions of each one that someone at your income level can start building today. But before we get to the 6 ways, you need to understand one thing, one fundamental truth that makes all 6 possible. Because without it, none of this makes sense, and all of it just looks like cheating. The tax code does not tax income equally. It taxes the source of income differently. Read that again. The money you earn by showing up somewhere and doing work is taxed at the highest rate the government charges. The money a wealthy person earns by owning something that grows while they sleep is taxed at a rate that can be less than half of that. Same government, same country, same calendar year. Completely different rates, just because of where the money came from. The IRS calls this the difference between ordinary income and capital gains. The wealthy call it the foundation of everything. Once you understand that distinction, the 6 strategies I am about to show you are not tricks. They are the logical, deliberate exploitation of a system that was designed, not accidentally, to reward ownership over labor. Now, the first way. There's a number sitting inside the tax code that most salaried employees have never heard of because it has nothing to do with salary. It's called depreciation, and it's the closest thing to a legal money printer that exists inside the American financial system. Here's how it works. When a wealthy person buys a building, a rental property, a warehouse, a commercial space, the IRS allows them to treat that building as if it is slowly falling apart, even if it isn't. Even if property values are rising, the government lets them claim a portion of the building's purchase price as a paper loss every single year for 27.5 years on residential property, 39 years on commercial. That paper loss, which costs them nothing because the building is not actually deteriorating, gets subtracted from their taxable income. So a person who owns a $2 million apartment building can claim roughly $72,000 a year in depreciation deductions. That $72,000 vanishes from their taxable income. Gone. And the building still exists. It's still appreciating. It's still generating rent. But on paper, the IRS sees a loss. This is how real estate investors show taxable incomes dramatically lower than their actual cash collected. The cash is real. The loss is engineered, and it's all perfectly legal because the tax code was written to encourage property ownership, and the people who wrote it owned property. The small version of this, it starts with a single rental unit. It doesn't require a $2 million building. The same depreciation mechanics work on a $180,000 duplex. The scale is smaller, but the architecture is identical. A single rental property generating modest cash flow can simultaneously generate a paper loss that offsets other income on your tax return. That's not investing for rent. That's investing for the tax position and taking the rent as a bonus. The second way is where it starts to get uncomfortable, because this one is not about property. It's about the structure of your business, or more precisely, the structure you're probably not using because nobody told you it existed. When you work a job, your employer withholds taxes from every paycheck. You never even see the money before the government takes its share. But when a business owner structures their compensation correctly, they get to choose when they pay taxes. And that choice alone is worth thousands of dollars a year. Here's the specific structure. A small business owner who sets up an S corporation can split their income into two buckets: salary, which is subject to payroll taxes, the same taxes gutting your paycheck right now, and distributions, which are not. They pay themselves a reasonable salary for the work they do. The IRS says reasonable. They define reasonable. Everything above that threshold comes out as a distribution, subject to income tax but exempt from payroll taxes, which currently sit at 15.3% on the first $160,000 of earned income. On $100,000 of business income, the difference between taking it all as salary versus splitting it properly with an S corporation structure can be $8,000 to $12,000 in annual tax savings, not tax to firms, not future obligations, actual money that stays in the owner's account and never reaches the IRS. Now, here's the honest part. Setting this up requires a real accountant who understands business structuring. It requires actual business income, and it requires treating your entity like a business, not a hobby. The people who get this wrong do so because they set it up sloppily. When it's set up correctly, it's one of the cleanest and most accessible wealth acceleration tools available to someone with a side income, a freelance practice, or a small business doing six figures. The third way is the one that will make you question every piece of financial advice you have ever received, specifically the advice to maximize your 401k. Not because the 401k is bad, but because it is the only tax-advantaged vehicle most employers ever mention, and the wealthy are not using 401ks as their primary tax shelter. They are using something most salaried employees have never been offered, and most accountants do not proactively discuss. It is called a defined benefit plan. And unlike a 401k, which caps contributions at around $23,000 per year in 2024, a defined benefit plan, specifically a cash balance plan, can allow a high-income business owner or self-employed individual to shelter anywhere from $100,000 to over $300,000 per year in pre-tax dollars, depending on their age and income. Every dollar that goes into that plan comes off their taxable income. A business owner contributing $200,000 a year into a cash balance plan at a 37% marginal tax rate is effectively getting a $74,000 annual subsidy from the federal government, in the form of taxes they never paid on money they still control. This is why wealthy business owners and high-earning physicians who structure their practices correctly can legally drive their taxable income down to a fraction of their actual earnings. The income is real. The tax on it is optional, deferred, and structured. Now, I am going to pause here for a second and ask you to do something. If any of what I have just said in the last few minutes has changed the way you think about money, the tax code, or the system you are operating inside, tell me in the comments. Tell me what you are realizing. Tell me what nobody ever showed you before today. And subscribe if you're watching this without having subscribed yet, because what is coming in the last 3 strategies is where this gets genuinely tactical. This is the part most financial creators do not cover because it requires them to actually know what they are talking about. We're just getting started. The fourth way is one that does not require a business at all. It requires only one thing: assets that have gone up in value. And hidden inside those assets is a strategy that is so counterintuitive that the first time you hear it, your brain will try to reject it. The strategy is never sell. When an asset you own, a stock, a piece of real estate, a business interest, increases in value, that gain is not taxed until you sell. The government cannot reach it while you're holding it. So the wealthy have built an entire financial architecture around holding assets indefinitely, borrowing against them to fund their lives, and letting the IRS wait forever. Here's the specific mechanism. A person holds $3 million in appreciated stock. They need $200,000 to fund the new investment. They could sell $200,000 of stock, pay capital gains tax on the gain, and keep the rest. Or they could go to a brokerage and borrow $200,000 against the portfolio at an interest rate somewhere between 4 and 7% depending on the size of the portfolio. The borrowed money is not income, it is debt. The IRS does not tax debt, so they receive $200,000 in cash, pay no capital gains tax, and their portfolio continues compounding untouched. The interest on the loan is a cost, but that cost is dramatically lower than the tax bill they avoided. And here's where it turns cold. When they die, the stepped-up basis provision in the tax code wipes out the accumulated gain permanently. Their heirs inherit the assets at market value. The loan gets paid from the estate. The lifetime of untaxed growth disappears from the IRS's ledger as if it never existed. The small version of this, every investor with a brokerage account holding appreciated positions can access a margin loan. The mechanics are identical. The rate is higher than what the ultra-wealthy gets, and the risk is real. Markets can drop, and a margin call is a brutal experience. But understanding that borrowing against assets is a legitimate tax strategy changes how you think about ever selling an appreciated position. Before you sell, the first question to ask is not what the tax will be. The first question is whether you can borrow against it instead. The fifth way involves something most people think of purely as an expense, and reclassifying it changes everything. It's the business deduction, not in the naive, I'll write off my lunch sense that gets people audited, in the structural, deliberate, documented sense that a real business uses to shift personal expenses into legitimate business costs that reduce taxable income. A person who owns a business and uses a vehicle primarily for business purposes can deduct the operating costs, the depreciation, or in some cases the full purchase price in the year it was bought under Section 179 of the tax code. A person who travels for legitimate business purposes can deduct those travel costs. A person who runs a business from a dedicated home office can deduct a proportional share of their rent or mortgage interest, utilities, and internet. None of this is aggressive, none of this is gray area, but it requires owning a business, maintaining documentation that would survive an audit, and understanding that the line between a legitimate business deduction and a personal expense is drawn by the IRS, not by what feels reasonable to you. The uncomfortable truth here is simple. When you pay for something with after-tax dollars, the government already collected their share. When a business pays for the same thing from pre-tax revenue, the government never sees it. The wealthy structure their lives so that as much of their consumption as legally possible flows through a business entity that pays for it before the tax is taken. You are buying the same car. One of you is buying it with money the government already taxed. The other is buying it with money that will never be taxed at all. The sixth way is the one that operates invisibly across every generation of wealthy families. Most people have never heard its technical name. They've only experienced it from the outside, watching dynasties persist across decades without visible erosion. It is called the Charitable Remainder Trust, and it is the closest thing to a tax-free asset sale that exists in the American tax system. Here is a scenario. An entrepreneur builds a company over 20 years. It is now worth $10 million. Their cost basis, what they originally paid or what the IRS treats as their starting value, is essentially zero. If they sell, the capital gains tax on $10 million at 20% plus the net investment income tax is nearly $2.4 million gone immediately. Instead, they transfer the company into a charitable remainder trust before the sale. The trust sells the company. Because a trust is a tax-exempt entity, it pays no capital gains tax on the sale. The full $10 million remains in the trust. The trust then pays the founder an annual income stream for the rest of their life, a percentage of the trust's value, generating income they pay ordinary tax on, yes, but over decades, not in a single brutal event. And they receive a partial charitable deduction in the year of contribution that reduces their ordinary income. At death, the remaining assets in the trust go to a charity or a donor-advised fund, which in many cases the family controls the grant-making of. The assets are not gone. The family's influence over them persists. The IRS bill was split across 30 years instead of paid in one, and a $2.4 million tax event became a lifetime income stream and a philanthropic legacy. The accessible version of this: anyone with a significantly appreciated asset, a stock position, real estate, a business, can explore a charitable remainder trust with an estate attorney. The threshold to make it worth the setup cost is typically somewhere around $250,000 in appreciated assets. It is not a strategy for someone with $5,000 in a brokerage, but it is a strategy that becomes relevant much earlier than most people think. Let me bring all six together now, because the pattern they form is the most important thing I can show you. Depreciation turns paper losses into real tax shields. Business structuring keeps payroll taxes from consuming business income. Cash balance plans let high earners shelter income at a scale a 401k could never reach. The borrow against assets strategy removes the event, the taxable sale, from the equation entirely. Business deductions shift consumption from after-tax dollars to pre-tax revenue, and the charitable trust converts a catastrophic single-year tax bill into a structured lifetime income with a legacy built into it. These are not six unrelated tricks. They are six expressions of the same single idea. The tax code does not tax outcomes. It taxes events. Sell an asset? That is an event. Earn a paycheck? That is an event. Pull a distribution outside a structure? That is an event. The wealthy have spent a century learning to live prosperously while triggering as few of those events as possible. And when an event must happen, they choose when it happens, how large it is, and what entity absorbs it. You will be told that taxes are the price of civilization. That is true. But nobody who understands this system believes that everyone is paying that price in equal proportion to what they own. The people who own the most pay the least per dollar of wealth created. Not because they're criminals, because they hired people who understood the menu and ordered strategically. The question is not whether the system is fair. The question is whether you understand it well enough to operate inside it, because it is the system you're in whether you study it or not. You are going to pay taxes regardless. The only variable left is how much, when, and through what structure. Start treating that variable like the financial decision it actually is. Pull your last 3 tax returns and find an accountant, not a tax preparer, an accountant who works with business owners, and ask them which of these 6 structures applies to your current situation. That single conversation will be worth more than anything else you do with money this year. The wealthy do not have better luck. They have better questions. Now you have them too. Subscribe to the channel if you don't want to miss the next one, and I'll see you there.